Welcome back to LVPDI 2020. I hope you enjoyed that last panel discussion, and we are now going to be talking about the absolutely crazy, insane, and hot residential resale market. I mean, it's just absolutely just gone bonkers. And I'd love for somebody to explain to us what the heck's going on. And maybe these three market experts can. We're joined by that lovely raven-haired beauty, Pam Junge. She's the Chief Venture Officer of our gold sponsor, the Junge Group, brokered by EXP. Hello, Pam. The debonair-looking, Mediterranean-looking guy right there, who should be like in some 1960s Italian film or something like that, is the president and CEO of Dara Capital Group, Kamran Khosravi. And then the lady who looks like she's in a training room, I don't know what you're doing. Oh my God, and there's a hand, and oh my gosh. That is the head of the state of Nevada for Old Republic title, Shosana Carro. Welcome, you guys. So I'd love for you guys to make kind of heads or tails of all this for me. What's happening? What is driving the resale market? I mean, what's driving all this? Pam, why don't you're out in the trenches out there. Please, why don't you start us off?
So listen, I think it's really just an economic discussion, right? So I think the biggest driver right now is these historically low interest rates. So you can look at interest rates almost like a lever. Interest rates are low and it drives people, gives them incentive to go spend, right? So a lot of people, what we're seeing, the big, huge push in the market right now is mostly a lot of millennials and first-time home buyers. And they're looking at it like this: if I could buy a home right now for equal to or less than I can pay in rent, I'm going to go secure that property. Even if the market ends up taking a little bit of a hit, as long as I can sustain that monthly debt, historically, owning a piece of real estate is a pretty good value. And not only that, we're seeing that most of these people out there are first-time home buyers. And the interesting thing is that what we're seeing in my group right now is that though they might be able to qualify for the mortgage payment, no one has a down payment right now. So a huge trend in the market is seller incentives. So for instance, we put a property on the market, we might get 6 or 7 offers in the first couple days. And I can guarantee you that at least five of those offers are going to ask for incentives, whereas the seller is going to help the buyer with their down payment and their closing costs. So it's a super interesting trend. These low interest rates have opened up home purchasing to a whole niche of people who might not have been able to do that before. And, millennials have recently taken over baby boomers. So they're our largest populace right now. And think about that age group. They're right at the age where they might be getting married. They might be having children. Maybe they're going from their starter home to their next benchmark home. So these are people on the move doing things in life, which are going to create familial situations where they would want to purchase homes.
So these,
one thing I'll throw in there.
You're looking at the long term. This is not like the old Vegas of flip them and sell them and cash it in. Nothing like that.
These are end users. These are end users, and we've got all this pent-up demand from the stay-at-home directive. There was a time when we were sheltering in place and sellers were not putting their homes on the market because COVID is a thing. It was a scary time to have people coming in and out of your home. So we went into the pandemic with a shortage of inventory. Then we have sellers keeping their homes off of the market. We have buyers who would normally be out looking in our spring season. Our two biggest pushes for selling homes are spring and summer. So we have all this pent up demand, and we're basically calling it the spring of summer because they're just out there in droves, regardless of what's going on around them. Social unrest, coronavirus, they're buying homes.
Kamran, you're Mr. Moneybags out there. I mean, you're working with the capital. How do you guys feel about this on your end? I mean, is the money flowing, and are you guys able to approve a lot of these loans, especially at the low interest rates?
Absolutely. Well, yes and no. Well, acknowledge Pam definitely nailed it with most of the area we're talking about. What's really driving this market? Low interest rate is one for sure, and we haven't seen a market like this before. We haven't seen a time like this before, obviously. And people being in a lockdown, and it's from lockdown to shopping, right? People are out there shopping. we see basically investors got afraid right after the pandemic, and everyone going to quarantine. Within the first week, we lost some of the programs, but we knew it's going to come back because there was uncertainty in the market, especially in the servicing area. We lost some of our jumbo product, which those are from the main player. We lost those. However, they're coming back slowly. We've seen a couple of new players in the game with new jumbo programs and guidelines. The guidelines are a little tougher, but we can see that it makes sense, basically tougher, not unreasonable. But we see those coming back and helping the jumbo pricing actually in town. And we operate in 5 states at this point, so we see that helping Nevada as well, because we do have loans over $510,000, which you would consider jumbo loan. So the bank statement program, we lost those, but they're coming back slowly. However, they're back. Bank statement program were designed for self-employed clients, for your folks that they own restaurants, they own small businesses, and obviously they take advantage of the tax tax benefit, and they show less on their tax return. We use the bank deposit for their income. So they were a little risky. However, they brought it back. Still, the pricing is not right for consumer. It's not great for consumer, but we have it at least on the menu, and rates are, a little higher than what it was pre-pandemic. That's pretty much it. And we see that people are buying homes right now, and idea is from like recent years of urbanization, from coming from urban coming to suburb now, right? People are moving to suburban area, so we see that a lot. People moving here from California. We got a lot of clients moving here from California, from our state, California, considering this town as a home. And working in California. Recently I heard Google had, I think, 50% of their folks working from home. So it makes sense for them to be working from Nevada, right? Being in Nevada and working from home. That's what we see. And money is basically, it's coming back, but it depending how the directive is going to be, and how what phase we're going to be, and we see that the investors making adjustment based on that. Just give you example, when the pandemic happened, we weren't funding loans until we had to call and last minute verify their job, that they had a job, because they could have been in hospitality or something and lose their job last minute, right? So that wasn't something in pre-pandemic we were doing. So we were basically verifying the jobs 3 times before we would fund the loan. Actually, we were issuing a PIN number for the escrow to get their money, from the wire department.
I want to ask Shosana, I know you were at the recorder's office, I think the other night till like really late. And by the way, I don't know if the system crashed, but I've been hearing some rumors that the recorder's office is like kaput. What's when you're seeing the recording of transactions, what is the bifurcation, the differences between refi versus actual home purchases? Because it seems like there's a disparity there.
There is a large disparity, David, and it's a good point. I believe Kamran even touched on it too. Rates have been low. And so what we're seeing is a large amount of refinance transactions. So I've got 2 different reports, and I do want to share just some information with you. Because I run all of Nevada, I did run all of Nevada, and then I separated out Clark County for you. But just first quarter of 2020, for all of Nevada, refinances, there was 21,983. And of those, 15,715 was Clark County. So what we've seen is a large amount of transactions. People have equity, so they're pulling cash out. Maybe they're doing projects because they are at home and working from home now. So we have seen a tremendous amount, definitely, of refinance transactions. But the interesting part is the resale has kept steady. We're not growing like we were in 2017, but the numbers are still consistent. We're still closing, 8,000 to 10,000 traditional resale transactions. I think, to Pam's point, there are sellers that are not putting their properties on the market. And if they are, they're not maybe priced where they need to be to be in that situation like you had mentioned, where you've got people asking for closing costs. And a lot of that is because they need that down payment money, or they don't have the money to put down on the property. So they're looking for that extra funds for the closing costs. But all in all, the market is pretty consistent.
What's the year-on-year difference between last
Do you
year?
want all of that or just Clark County, David?
Let's look at Clark County.
So Clark County, if you looked at first quarter of this year, and this includes REOs, subdivision, things of that nature. So Q1, we did 27,775 transactions. In the same quarter of 2018, 23,503. So yes, it's down, but not a large amount. And again, that's including the new subdivision. So I think we're seeing more new home build and more new home closings than we had in the last few years.
I'm going to borrow from our first panelist, Guy Martin, his redneckonomics, which I'm a big fan of that term. Is the fact that there aren't down payments, is that a little bit concerning for you guys? I mean, that's quite a bit of leverage. That's quite a bit of money to be in without having much skin in the game. Does that kind of make you?
Yeah, Cameron can probably talk to this point as far as down payment assistance programs. Is it concerning? A touch, because there's no money invested. So we're kind of, in my mind, in a 2008 environment where they don't have skin in the game, right? So we're giving them money for the down payment, or the seller is giving them money for their closing costs. They don't have anything to lose if they were to walk away. So I think Cameron's probably best suited to answer that.
So the question was if people don't have a skin in the game with the down payment assistance program. I think the down payment assistance program will be pretty tough to get, frankly, because of debt to income ratio and the stability of the job. I don't think, and it has shown last 10 years, people putting 3% down or 3.5% down. That's similar to down payment assistance program to me. Yeah, we haven't seen actually the foreclosure rate or delinquency rate has been really low. I don't think that would be a concern, because they're pre-qualified when they, very tough. Like, if you have to touch a file 5 times, let's say on a typical prime loan on the down payment assistance program, they'd be touching it 10 to 15 times. So they get more attention to make sure they're qualified as they're purchasing it.
Pam, I know you were chomping at the bit to jump in there.
No, so Sana just nailed it. I just think it's so incredibly interesting that technically, I think our resales are only down 15% year over year. And that is amidst everything that's going on in the world right now. And I think that's a credible testament to homeownership in and of itself. And, I know there's a lot of anecdotal analysis out there about what's going to happen in the market. But the truth of the matter is that we really just don't have enough data right now to determine anything. Because I keep saying it over and over again, but I don't feel like the world has ever moved so slow and concurrently changed so fast. There's a lot of factors in the housing market right now. If you just you've probably had some home remodelers on some previous panels, but they're going crazy. I mean, you look at all the social experiments that are going on in the world right now, and people are reanalyzing their homes. They're reanalyzing their space. Because if I'm going to work from home now, I'm looking at it differently. It might not, I might be looking at my kitchen sink thinking, wow, I didn't realize this is like 20 years old. I need to replace this kitchen sink. Or you know what they're doing? They're putting audio pods in their homes now. So Zoom rooms, they call them. So they're bringing contractors in to create a space that is going to be more compatible for these social experiments of working from home. And, psychologists will tell you it takes 30 days to form a habit. Well, how long have we been sheltering in place? So companies are embracing this new, work from home thought process, and homeowners are really just reevaluating their spaces. So it's causing them to want new space, and it's causing them to improve the spaces that they're in. Pool companies have slayed it during the stay-at-home directive. People are upgrading their yards and, just really reevaluating how they live. I think it was it Tom Van Betten who was like, hey, I could sit at home all day in my pajamas and I go from this room to this room to this room. It's work. work and live balance, right?
I had sweat. I kid you not. I wore sweatpants for over 30 days. And then when I put on my jeans, I went, wow, they shrunk. And I haven't even washed them. So no, it's true. It's very true. We have made that change. There's also been a lot of, you hear a lot about forbearance, loan modifications. I mean, obviously there's been some safeguards that have been put in place by the federal government because they want to prevent a crash, a housing crash. How is that kind of, I'm not going to call it manipulated because it's not really manipulation, but how has that affected the market and influenced some of the things that are going on right now and maybe even kind of fueled this this meteoric increase in sales?
Well, first of all, I've done some research. I talked to a couple of executives at major banks recently about this. We're not going to see. I think we spoke with Pam a couple of weeks ago with this regard. We had some differences on some numbers, right? But I think I'm more leaning towards what Pam was saying, okay? Because I don't see a major impact on forbearance. Black Knights report that 1 out of 10 homeowners in forbearance, that holds only, they have 10% less equity. So basically, a lot of people have equity on their properties. They're not gonna, they're gonna go in forbearance, yes. But forbearance, I call it like it's becoming like a reverse mortgage, right? Okay, so yes, they're getting forbearance. Some people don't even need forbearance and they're taking it, which in a way that's good too. Why? Because if they don't need forbearance, they're taking advantage of not paying that payment. However, they can turn around and pay those high interest rate credit card or other personal loans they have. So that definitely is going to fuel the market, right? I mean, a lot of people are responsible out there. However, they're taking advantage of forbearance. I see that, as far as the investors are concerned, if you see we are working with several investors. So some investor, they don't like forbearance. If they see a forbearance and you're trying to upgrade your property, go to another house, they want to make sure your forbearance that you have on your current house, it's paid, and it's paid within 6 months current before they touch that loan. However, we have other investors that as long as your forbearance is current, they go ahead and take the loan. So I don't see a lot, a lot of changes in the market with that. I think it's actually helping the market, and it's just basically people using it that they really need to use. But overall, it's helping the market, I think.
I guess my big concern from looking at the economics of it is, will we potentially end up, especially with the way we've been seeing the market going with Boyd Gaming, the layoffs that were announced yesterday, losing a quarter of their staff. We heard this morning Jeff Vilken, the contractor, talking about how in the next couple of years, there's going to be a lot of businesses that will no longer be in existence, and a lot of them here in Las Vegas. If we continue to see that assistance, that forbearance, and those modifications in play, do we what's the timeline before we kind of have that kind of start kicking us in the backside if economic conditions don't progress?
The magnitude and the volatility of this labor implosion is something that none of us can wrap our heads around right now. I mean, it makes it so much harder to actually put a number on the unemployed right now. I believe they're reporting 2.4 million in the nation approximately right now. However, if you look at Las Vegas in particular, I have clients and I have friends who are gig workers, independent contractors, but those businesses are wrapped around the resort industry. So I have a client who called me, lives in a beautiful home in Summerlin that she's going to have to sell because her business, she actually stocks all the mini bars in the casino and the hotel rooms in the casinos. She has no business. Another company that works right down the hall from me, they do nothing but ship and pack for conventions. We don't know when we're going to have another convention in Las Vegas. So these are businesses that have been hit really hard. These people are technically unemployed. It's just this labor implosion is so hard to wrap your head around, especially in Las Vegas, because of so many other people that are affected because of the business that they own. If we keep suffering pandemic shockwaves, unemployment, we're gonna be in for a long road of hurts. So if the pandemic, a lot of people have spoken to the vaccine. I don't know when there's going to be a vaccine, and if there's, how soon that's going to actually be able to get the pandemic under control. But these aftershock waves that keep affecting unemployment are definitely going to filter over into housing and other types of areas. Again, it's a lot of anecdotal analysis out there because we're going through something that we've never experienced before. And it's just, we don't have enough time underneath our belt.
Who are buying a lot of these properties? I mean, obviously this is a sale. Someone has to go and put their house on the market because they're out of business. Their business is going down. But who's actually doing the purchases? I mean, when we're recording these transactions, are they casino workers? Are they people from California? People moving in from out of state? What's the demographic?
Cameron has good data on this.
Okay, yes, sure. Well, in our business, basically, because we do refinance and purchases, obviously, it's interesting that when the pandemic happened, we had a gap in our pipeline, we'd call it, right? And but within a couple of weeks, it was recovered with essential workers. So I've got detective in California, I've got ATC in Las Vegas, physicians, pharmacists, chiropractor, nurses, and electrician, you name it. It's very interesting that we didn't lose that much business to hospitality. That's our experience, okay? First-time home buyers, we see a lot of first-time home buyers. We see some upgrades, but not they're upgrading, upgrades probably up to $450,000, $500,000 house, nothing more than that. But that's basically what we've seen. A lot of people moving into state. I mean, as Pam mentioned, multiple offers. We see Californians coming, buying cash. That's what our experience has been with some clients. So yeah, that's filling the market. And I think, am I concerned about, hospitality losing jobs and inventory be a little higher in the future because people are going to have equity in their property, and if they don't have a job, they've got to put the house in the market to sell and take advantage, take their equity before they can be delayed on their mortgage. Yes, however, I think the people moving here, I got people moving here from Chicago, from Detroit, we have from East Coast, basically we have a lot of people moving, as well as California. 35% I think is from California. But I think that's gonna not totally, but almost offset. As your other panelist was saying, we need to market Vegas. Vegas to me is a hidden secret. Living in California for 28, 29 years, being here for last 5 years, this place is a hidden secret. People got to know about this place, right? And looks like some people know already and they're moving in town. So that's what we see.
As long as we don't decimate ourselves with tax increases, right? I mean, right now we're still attractive. We still have a low tax base, but let's face it, it's the casinos that paid most of our taxes. So, that could be Las Vegas kryptonite. And Cameron, I think you're 100% right. And I'm all Las Vegas. I am 100% in on Las Vegas, and I love this town and I love this city. However, it's going to be very interesting to see where our government leaders take us. And if they impose a state tax or something like that, it could just be our kryptonite. How many people are still going to move here and move their businesses here? I mean, that's a big concern.
I'm wondering if Shosana hears any rumblings. I mean, you guys, your team is out there in the field talking to the brokers and to the different real estate agents. What's kind of the sense that they're getting out there? If you want to reveal that piece of information.
I think that there is concern, and their numbers aren't necessarily where they usually are. And to Pam and Cameron's point, we're seeing about a quarter of our transactions that are closing from buyers from out of state, whether it be East Coast or California, because again, we do have great benefit, right? With no state tax, we've got a great area to live in and call home. So I think they're cautious. We're cautiously optimistic that the market will continue. We're not going to see large surges of purchase transactions, I think, through the end of 2020. I think 2021 will be a fresh start, and we'll kind of get a gauge of how we finished out 2020 and go from there. You're not seeing agents doing walking farms anymore, or door-to-door, trying to talk to a consumer about buying or selling property. So it's really gone to a virtual environment. And most of our marketing collateral, just from the title perspective, is now all virtual. So real estate agents, I think, and I know Pam is a prime example of this, are in a virtual world, and the way that you're marketing yourself on social media, all of that changes. And, you know, we went from working in large offices to realizing in 24 hours we could move everybody home. And who would have thought that this would be an accessory? You know, life changed. And so we have to continue to adapt and change with it, including our real estate and lender partners.
I'm curious to see, there's been some people that have drawn similarities between 2008 and now. How is this different? How is this the same? I mean, I'm sure that this is the first thing that when you see something like this, it must evoke emotions around that. You know, it's a little, you know, it's over a decade ago, but it's a little too close for comfort. How is this different? How might this be similar to that 2008 market implosion?
So the interesting piece is the unemployment rate is very similar to what it was in 2008. So stats just came out this morning, 32%. Again, I believe that a large amount of that is hospitality. And as we indicated throughout the conference, you know, construction is still there and new builds are still there. So the transition of people that are currently unemployed, yet we've got people moving in from out of state, like you've indicated, has kind of offset that. But to be very honest, the number of transactions is very comparable. And that was surprising for me. So in 2008, the number of resale transactions for the whole year was 31,617. Okay, and what did we say first quarter was just of this year? In just resale, we have closed 8,042 just in the first quarter. So for me, that's a good indication that we're better off, obviously, than we were in 2008. And again, we're better positioned. The forbearance, I think, created help for many people that were unemployed. Again, that transitions and adds on to the back end of the loan, but it allowed people to stay in their homes. And, you know, we do have a number of transactions like Kamran indicated. They go to do a VOE on the day of closing now, where we were doing those VOEs 30 days prior to closing. And so we have a number of transactions that are on hold, just waiting for those people to get back to work.
I'm curious about the types of properties out there that are in favor. I mean, Kamran, you mentioned, you know, jumbo loans. I'd assume these are larger properties. I mean, is there a particular sort of a cream of the crop of the market that's in higher demand, or is it all across the board? I mean, are we seeing McMansions, if you will, that are also in high demand?
I think the interesting thing is not just the median priced home, and let's just back into that for a second and reverse engineer. So if you remember in March, the Review Journal proudly plastered on the front page that despite coronavirus, median home values went up to $319,000, which was incredible, right? But what they failed to report in that article is that what records in March, as Shosana and Kamran can tell you, that went put into escrow in January and February. So that was January and February activity, but it recorded in March. So we went up to $319,000 median home price, which was great. And then again in June, because of supply and demand, we have a huge shortage of inventory on the market right now for all the demand that's out there. So natural cause of supply and demand, when you have a shortage of supply and demand is high, your values are going to increase. So in June, we recorded a new value of $325,000. So with that as a basis, to answer your actual question, I would have thought originally that, you know, the median home price where people could afford a payment that might be equivalent to rent would be like the bread and butter, the market, that's what's going. But I got to tell you, anything I put on the market or my team puts on the market less than $600,000 is flying off the shelves. So Kamran spoke a little bit to the fact that, you know, jumbo financing is available again. It's not, the terms aren't quite as favorable as your conventional Fannie Mae and Freddie Mac. However, it's still a great interest rate, and they're flying off the shelf. As far as I can tell you right now, it's anything priced from median up to about $600,000. We can't keep it on the market. And there's something bubbling in the luxury market as well. It's interesting, and again, it's all anecdotal information, but you see a lot of people looking into the luxury market now that previously weren't, and I'm not sure why. I don't know if it's, wealthier people taking advantage of Las Vegas and moving here now, that maybe necessarily don't need jobs here, but they're looking in the luxury market. So we'll probably be able to clarify that in the next coming months with some numbers, but the luxury market seems to be bubbling a little bit.
An interesting comment was made here in the chat box saying, well, first quarter numbers, yeah, they look good. Second quarter is really what matters. And by the way, it's a moving target. I mean, we've said this all along. It's like, oh, wait till this, wait till that. I mean, according to John Restrepo yesterday, he said, well, wait till the end of Q3, end of Q4, and then you'll have an idea of where the chips are. I mean, how long are you waiting to kind of start to feel a little bit more settled with where the market is? And that's a question for all three of you.
Well, first, I want to answer your other question, if you don't mind, about the difference between 2008 and now. Okay. Number one is what we're experiencing. I mean, I can speak to that all day long. Okay. 2008, definitely people didn't have skin in the game. Okay. 2008, we had investors that actually they were calling us, hey, we got programs for investment product, W-2 borrower, 100%, no down payment, as long as they had a 700 FICO. Just imagine that, right? But right now, everyone has
ninja loans, right, Cameron? Those were ninja loans.
That's
no,
right. But
approved.
Yeah, but ninja loan and being investment product, that's the problem. I mean, ninja loan for owner occupied, okay, fine, makes sense. But for investment product, it was like crazy. And then we were getting approached by investors. There was too much money, I guess, out there. But right now, most of the product, first of all, on the prime side, people have 3 to 5% down payment. They're well qualified, full document. They're well qualified, certain credit score, no problem. And on the non-prime product, which is basically replace the old subprime product, right? We only lend to self-employed folks, right? Or investor. So if a self-employed borrower comes in, we analyze the 12 to 24 months, the bank statement, analyzing their deposit, make sure the deposits are actual deposit, right deposit, which is their income from their business. It's not like, mom deposit $10,000 a month for me right now. I'll give it back to you and later I'm going to buy a house. No, it's not that. We analyze it, right? And we got few background check, which it costs approximately, the lenders, everyone can speak to that. It costs $300-400 just to do the background check, whether we close the loan or not. Okay, and to find out whether they had, they have interest in other properties or not. We do a last minute check with MERS, see if they're closing anything at the same time that we're not aware of it. Okay, so everyone has a skin in the game. To just give you an idea, right now on the non-prime side, which was very strong until now the rates are a little higher, but we have under 0.5% delinquency. Average equity on those properties are 30%. Average FICO score is 720. So during this time, nothing went wrong. They're paying, I talked to some people on the servicing side. Yes, they're giving people forbearance, obviously, but it didn't really affect the market. Okay. And what was the other question you asked?
When do you start to kind of get a clearer picture of where the market is? I mean, we've got, the goalposts keep moving.
Right.
We keep saying, oh, wait till this month. For you guys, I mean, you guys are in the trenches. You guys are seeing this. I mean, I'm on the outside. I can wait for the data.
Yeah, it's crazy. First of all, I think Pam and Shosana mentioned that it's crazy. First of all, we didn't know what's going to happen, right? We thought we were going to have some of us thought we're going to have a crash. I know people that they put the house. Put the house in the market. I know someone that he put all his houses in the market. I go, what are you doing? He goes, I don't think we're going to have a crash. We're going to have a crash. Now, surprisingly, we have a multiple offer on all the properties, right? So nobody knows what's going to happen. But I think, with Fed chairman saying that we're going to have enough ammunition to throw at this thing, that's a positive thing. So in other words, they're talking about another stimulus package, right? I think I heard today 85% of the states supporting that, another stimulus package. So that's going to be helpful. And regardless of who's going to be running the White House or Senate or House, I think everyone is for housing. So definitely, I think government is going to jump in and help the market. And as folks mentioned yesterday, I think we need probably another quarter, but third and fourth quarter, we know where we stand. And especially vaccine, if there is a hope vaccine coming by the end of the year, that's going to be very helpful.
I think it's interesting too that as of yesterday or the day before, California shut down again. And so we think that we've kind of passed or surpassed where we needed to be able to return to some sort of whatever today's normalcy looks like. And then to have that happen yesterday, I think it causes pause for us, especially because of, again, hospitality and entertainment. Our hotels are at 50% occupancy. We're looking at people that aren't working that need to be working. So I think as California usually is the here we are, and then Nevada is kind of the here we come. I think that we may have, and we've seen it with the bars being rolled back. We're just going to have to, it's a wait and see. This is something none of us have experienced in our lifetime, and hopefully this will be it and we won't again. But I think that we have to be cautious and understand that we don't understand this virus and how this virus will affect not only real estate, but our economy as a whole.
I'll just chime in. I agree with Shosana and Kamran 100%. There's way too many moving parts and pieces. And if you look at what we have to the future to look forward to, we still have an eviction moratorium that's going to be lifted, and we don't know exactly how tenants and landlords have been affected. I think they reported something like Reno and Sparks, 41,000 evictions. So we don't know the totality of that until that moratorium gets lifted. We talked about deferment. A lot of people were confused when they actually called their banks and actually put their loans in deferment. So I'm really hoping that these loans actually got modified, and when the deferment expires, they're not going to be having to pay 6 months or 12 months worth of payments because their loan wasn't actually modified the correct way. Because servicers were pushing people into not following through with modification. Because if you think about it, the servicer also has debt obligation, just like a landlord has debt obligation. So we'll see what happens when these forbearances come to term. Then we also have the election, and things. The market always gets, the market always seems to go a little bit on pause during an election. We don't know what the status of COVID is going to be. I think a lot of people thought COVID was kind of going to be like a flash in the pan. We were going to get it under control, and that when the directives came out, that we were just going to go back to life as normal. And now we know that that's actually not the case. Life as we know it is changing dramatically and quickly. Boyd just laid off another 2,500 people a couple days ago. Now we have casinos that were open and taking reservations full time. Now they're just taking reservations on the weekends. So there's possibly more unemployment on the way. There are too many moving parts and pieces right now for, I think, even the finest of economists to try and say where we're going to be and when it's going to happen. There's just too much in play.
Right. I want to just speak to forbearance and deferment, basically, because I talked to a couple of executives, as I said, about this issue with servicing. They're one of the top servicing in the country. What they mentioned, governments basically on the Govy loans, you're going to have, they're going to become second trustee, so they're not going to be due based on my best of my research and knowledge. So they're not going to be due when the forbearance is open. And the GSE, government sponsor enterprise is going to be, they're going to have basically modify or defer it to the end of when they sell the property or something. So actually they're going to extend the terms. So in other words, if you have 12 months forbearance, they're going to extend your loan 12 months more than what it was. If it was 360, then it's going to be 372 months. So I'm not too concerned about that affecting the market.
One thing I forgot to mention, just the copious amount of stimulus funds that are in the market right now. So if you're one of the lucky people that's actually getting your unemployment, that extra $600 a week in pandemic unemployment is going to run out at the end of this month, right? And so maybe some people who actually, to Anna Hensley's point, Anna, did you just say you've got 28% of your tenants are unpaid? 28% of her portfolio is unpaid. And maybe they are getting stimulus funds and they're not using them for rent. However, those funds are going to run out, we hear, at the end of this month. That could be holding families together. I'm sure there are a lot of good people who are taking those funds and actually making the mortgage payment or making the rent payment. So again, that's another huge factor to see where we go from there. And to Cameron's point, I know there's talk about another stimulus package, but I haven't seen anything hardcore or positive in that direction recently. And how much money, David, you can answer this question. How much money can the government throw at this thing?
Well, so just, yeah, no, that's a great question. So we were already over 100% debt to GDP, which is a very scary number to be at. I think we're about 24 to 26 trillion dollars in debt. Our GDP is about, well, it's going to be readjusted. Our GDP is somewhere between 21 and 22 trillion dollars. So, we're maxing out the credit card. It's very likely that for us to get through this, we may need to have as much as 30 or 32 trillion dollars in debt, which puts us at a very, very scary number, 150% debt to GDP. So just want to throw that in there. And I'm sorry to, just want to throw that in there. Shosana, I think you had a comment that you wanted to make as well.
So to Cameron's point about forbearance, every lender is different, and we're seeing different caveats to each one of these that have gone into forbearance. So I think it's very important to educate the client to read the paperwork, because in some of these issues, you have no refi or sale in a 24-month period. So when they've signed up for this no payment, you're dealing with some very large things on the back end. So I think really reading and reviewing that contract with your client is extremely important.
One question I had was, and Cameron, you alluded a little bit to, the bank statement program, and business, how it's based on what you've got in the bank, et cetera. Well, what businesses have had in the bank prior to March is going to be maybe very different to what they've got after March, especially if we're talking about restaurants, retail, et cetera, small businesses. At what point do we start to get a little bit skittish with small business owners who are like, I want to invest in property?
I guess we have pretty much, that's a very good question. And we have some loans that have that issue. First of all, we are asking for a recent bank statement, okay? And we're asking for P&L. We're comparing those depending what type of business they're in, whether it's essential or not. So we do more investigation. So that's why it's been tough. Like I had a loan approval for a client in March before pandemic. So we stopped that loan. Now they lost that property. They went bought another property, but we were having a tough time approving him because we're putting him, we're tougher on the guideline at this point. And when I talk to the investor, they go, well, we had Wall Street purchaser. We had 3 options. Now we only have 1 option, and we have to really be tough on the guideline. So to that point, it has to make sense. And we've been very successful on that to make sure it makes sense. We have enough tools in hand to make sure it makes sense, and there is no, is not a wishy-washy type of a deal that we're funding.
And can I just add to that, the Dodd-Frank Act of 2011, which really helped clean up a lot of this guidelines and regulations for lending, it also cleaned up other areas of the property market as well. So, for instance, appraisals. As a realtor, we used to be able to pick our own appraisers. Very convenient. If you had a deal that might be a little borderline, it's cleaned up everything involving the real estate transaction. So it goes well beyond just lending guidelines. So as a whole, we're way better situated going into this pandemic. Like everybody has spoken to, most property owners went into the pandemic with equity in their properties, and the scrutiny that they're under and the scrutiny that the transaction as a whole is under today is completely different. So,
for sure.
All right, guys, we're coming to the end of it. We've got 2 minutes left. Crystal ball time. Where's the market going? When do you start getting jittery? When you start getting nervous? What's going to happen to Las Vegas? And what are our prospects? Shosana, let's start with you.
So we've been here before. You know, 2008 was a different time. But we also are, I think, better prepared today than we were then. Banks have a different position. Homeowners think a little differently. I wish I had a crystal ball because I would have picked the winning lottery numbers. But I think that we're just going to have a transition. I don't believe we'll have a dip like we did in 08, but it will be a transition, and business will be conducted very differently. You know, we're allowed to notarize documents now. As long as I'm sitting in Nevada, I can notarize somebody that's in China or Russia on vacation. So business has changed. Our models have evolved and will continue to evolve as our market shifts.
No, absolutely, absolutely. I think nobody knows. We don't have a crystal ball. I would buy another ticket too, as well. But I think we've been through this. You know, the country has been through this. We live in the greatest country in the world. We live in the best town in the country, right? You know, I think we're going to come through, and it's just a process we have to go through. The government is there to help if need to. People are more educated. They're not overextending themselves. You know, they're smarter than they were. I think that they were as far as financial in 2008. So definitely, I see a brighter future. We just have to educate our client. You know, the agents out there got to educate the client. Agents have to be on this type of conference and educate themselves. You know, what Einstein said, something like the success, the knowledge you have that you got the success you have, it's not sufficient enough to maintain the success, right? So that's what we have to pay attention to. As a business owner, as agents, as you know, being in the business, you know, even as an individual, right? So I see it just looking at another someone in a panel was saying, you know, he said, I don't want to be a Tony Robbins, but really whatever you speak is going to happen, right? We speak it, we look at the brighter side and keep moving forward.
But by the way, I just want to throw this in there. I mean, what a great conference. We're getting quotes from Tony Robbins, Plato, Einstein. I mean, come on. You don't get that at the other conferences. Final words.
I plead the fifth. I'm just kidding. Listen, I don't want to be, you know, I love Las Vegas and I believe in this city, and by no means am I a Debbie Downer, but I do believe that we're going to go through a little pain. Just like any good business right now, the city and housing is going to right size. We're going to have to restructure some things. We've got an incredible amount of great real estate agents in Las Vegas to counsel people through these issues. We've got a shortage of inventory, so once some houses start loosening up and coming back on the market, because they will, we will probably stabilize values. I believe we will probably see a bit. I know, Shosana, you called the 2008 a dip. I use a different adjective other than home prices dropping than a dip, but I do believe we'll see a little dip now. And I think we're going to come out of it fine. I think we're going to come out of it strong. Las Vegas is still an incredible place to live. Homeownership is always going to be valuable. And again, where can you put your money as far as historically? Where can you put your money? Where else could you put your money that it can do for you what homeownership can do? So we're in for a little bit of pain, and we're going to come out stronger.
You know, Matt Watkins here in the comment section said, hey, no pain, no gain. So, you know, we'll take a little bit of pain. We're Vegas stronger. Very great panel. Thank you very much to each and every one of you. Shosana, public title, Kamran Khosravi, the debonair Kamran from Dara Capital Group, and the raven-haired beauty, Pam Junge of the Junge Group, brokered by EXP.